Welcome everyone to Oregon Small Woodlands Association Forestry Taxation webinar series. This is the fifth in our series of 7 webinars to help you learn all about forestry taxation and how it relates to your property. Last time, Clint Benz covered deducting expenses, and today, Clint will cover capital expenditures. The handouts, slides, and videos from previous webinars can be found on our website, and I'll share that link in the chat for you. If you have any questions throughout the webinar, please use the question and answer tab located at the bottom of your screen, and we'll do some question and answer at the end. And with that, I will hand it over to Clint Benz. Thanks so much.
It's good to see everybody. Glad you're back. Today we're going to talk about something really exciting, which is capital expenditures. So those of you who have been slogging through the desert here with me, today is going to be interesting. So I'll bring up my slides here and we'll get started. So as you all know, have been part of this series. We've been doing a 7-week series. This one is now we're week 5 on capital expenditures. The preceding 4 weeks, the videos are online at the OSWA.org website, as well as the materials. And so we'll continue doing that as we go forward. And today we're going to be talking about capital expenditures. So, and there's 4 major topics. The first one is going to be looking at cost basis and depletion. We'll probably spend about half of the time today on this issue. This is, we've been talking about this throughout the course about depletion and your cost basis. When you sell your timber, what is your cost basis? We're going to go over that in some detail today. Then we're going to spend some time talking about reforestation, road construction, which is a big issue for many of us. So, and it's a question I hear constantly, what expenses can I deduct? What expenses do I have to capitalize for roads? And then we're going to finish up talking about other capital expenditures and depreciation. So how do you write off when you buy a truck or a cat or a pickup or equipment or whatever else you have? So what do we do with depreciation and other capital expenditures? All right, so let's get right into this. If you have your handouts that I gave you, we're going to start here on page 3. So when you sell your timber, so let's say you sell your timber and you get $100,000 from the sale. Of course, from that you deduct your harvest and your sale costs. So the cost of logging and hauling and all those other costs. But you also get to deduct the cost of your original cost basis in the timber. So this is just like if you bought stocks. So say you bought some stock in Microsoft and you paid $50, and then later you sell it for $70. You only pay the tax on the difference between what you paid for it, $50, and what you sold for it, $70. So you have a $20 gain, and that's what you pay tax on. You have to report the whole $70. So you report, I have a gain or an income of $70. I've got a cost basis of 50, and the taxable gain is 20. And so when we determine our income from the sale of timber, we do the same thing. We deduct our harvest and sale cost and the cost basis of our timber. And how we deduct that cost basis is through something we call depletion. So we look at our adjusted basis in the timber. So the adjusted basis in the timber is our after-tax cost of acquisition. So if we're buying it, we're paying cash, or we borrow money. Cash and debt are treated the same way. So if we buy it either with, let's say we put $100,000 down and we borrow $900,000, and we have $1 million of investment. That is our basis. So we've put $100,000 in cash, $900,000 in debt. That gets us $1 million of basis. If we trade in another property, so say we do a 1031 exchange, and we have a property that, you know, has maybe a $500,000 basis that we own, and we go and we buy $1 million property, we trade in that $500,000 property on it, so we put in another $500,000 of our own money. So our cost basis is the $500,000 of new money that we put in, plus whatever our basis was in the old property, if we do a 1031 exchange. So it's our after-tax cost of acquisition. We're also going to talk about if the property was inherited, that after-tax cost of acquisition that from inheritance is the fair value at the date of death of the decedent that we inherited it from. So that would be the basis there for inheritance. And if we have a gift during lifetime, it would be the basis of the person who gave it to us. So so that's our after-tax cost of acquisition, plus any costs of capital improvements that we put on the property. So the whatever the cost of the improvements are, minus then all of our depletion, depreciation, and amortization deductions. So that is our adjusted basis in the property as a whole. So if we buy a piece of property, we put a house, we put a barn on it, maybe we're renting out the house, and so we get a depreciation deductions. We're using the barn for business, we get the depreciation deductions. We do some reforestation, we get our amortization deductions. So all those capital improvements that we make, plus the cost of acquisition, minus all those deductions that we were able to take, is our adjusted cost basis in the property. And for most of us, we kind of look at it that way. We have kind of, it's one thing, it's all together. And what the government requires of us is actually to break those things apart. So they want us to hold our base, to allocate that cost of acquisition between the timber, the land, and the improvements. And so they want us to have those things separated out. If we have, and so we have to allocate those things. So the other improvements are like, so if you're an investor and we capitalize those carrying charges. So the property taxes, the mortgage interest, maybe it was something we're going to talk about here a little bit, maybe our timber stand improvement, our fertilization, other costs, because we can't deduct them currently. If we capitalize those are treated as our capital improvements. And those, depending on our status, we can, in fact, even as an investor, we can depreciate those items. But that depreciation would show up on Schedule A as a miscellaneous itemized deduction. So again, you wouldn't be taking those costs out right now, because those the depreciation, what have you, are suspended. Those miscellaneous itemized deductions are suspended for investors, as we've talked about before. The total cost of the timber and the land we have to allocate between, we have to allocate it between our property. So we have to allocate it between the land, the timber, and the other improvements. And we'll get into that in a little bit, how we do that allocation. But we are required to allocate that basis to all those different items that have value. For gain purposes, our holding period begins on the day after the date of our acquisition, and it stops on the date of sale. And why this is important is because if we're going to have a long-term capital gain treatment, or if we're going to do a 631A and use the 1231 treatment, we have to have owned this for 12 months and a day before we get long-term capital gain treatment. And so that 12 months and a day, that holding period starts the day after the date of acquisition and stops on the date of sale. So that's how we count the days. Depreciation, however, starts on the date that you placed it in service. You can buy something and it sits idle, or maybe you buy it and you put it in your shop and you're working on it, or maybe say you're constructing an improvement. So maybe you're constructing a building. It takes 5 or 6 months to construct it. All those costs are held until you are done and you place the asset in service. And that date that you place it in service is the day that you start depreciation on the asset. We're required to maintain accounts for our timber and our land. And if we have immature timber, so if we acquire a piece of property and it's got mature timber and it's got pre-merchantable timber and lands, that's maybe so the only 3 things that are on there, we're supposed to allocate that purchase price between those 3 categories. And the land that's in the pre-merchantable account, or the timber that's in the pre-merchantable account, stays there. It's not part of our depletion until that timber becomes merchantable. And so when that timber becomes merchantable, then we release the cost, take it out of the pre-merchantable account and put it into our timber account. And our timber account is what we use to compute our depletion, because that timber account is the one that shows us our cost basis in our timber. So if we're looking at our cost basis and our holding period, when, again, so this is a little chart here. So depending on how we acquired it, so if we acquired it through purchase or through an exchange, our cost basis in the property is the after-tax cost of acquisition. We're required to allocate that cost basis between all those components of value, the land, the timber, the improvements. Our holding period starts the day after we buy it. If we inherit it at death, we get the cost basis is the fair market value at the date of death. And again, that's supposed to be allocated between the land, the timber, the pre-merchantable timber, and all the improvements. So that cost basis gets allocated among there. And our holding period is long-term, whether or not, it doesn't matter when the decedent purchased it. So the decedent purchased it the day before they died. So they owned it for 1 day and then they get hit by a bus. We valued it at the fair value at the date of death, and the heirs, get a long-term holding period for that, regardless of how long the decedent held it. Lifetime gifts. So if something is transferred to us during the donor's lifetime, so if dad gives property to his children, mom and dad give their property to the children while mom and dad are still alive, then the children get that gift. Their basis is the mom and dad's basis. It's the basis that they had. And the holding period is also mom and dad's holding period. So if mom and dad bought this property back in the 50s, and then whatever they paid for it back then, whatever their adjusted cost basis is now, so we take the original cost basis back when they bought it in 1950, plus any capital improvements, minus their depreciation. But that allocation of cost basis between the land, the timber, and everything else, that is based on their purchase date back in 1950, not when the gift occurs now. So we don't have a revaluation. So even though lifetime gifts were required to value them at fair value for purposes of the gift tax, we do not get a new cost basis for lifetime transfers. And the holding period is the donor's holding period, so whatever that is. There are some, there's a lot of tax law being thrown around right now, or being considered in Congress, which would significantly change some of these things. And one of the things that they're looking at changing is getting rid of we call the step up in basis at death. So they'd make death transfers the same as life transfers, in that there would not be a step up in basis at death. We'd still value at fair value, but you'd have the donor's basis. This idea of step up in basis at death was put in the code back in the 70s as a tax simplification measure, because, I mean, the person who knew what they paid for it isn't there anymore. And so for the heirs, when they receive this property, It had just gone through a tax situation, a taxable event, the estate, but we gave them a new basis, kind of a fresh start, simply because it was very difficult to determine what the cost basis of these assets were. Lifetime transfers, the person who purchased the asset is still around to ask the question, what is your basis in the property? And hopefully they know what their basis in the property was. So I had a client who sold some timber, and they got a very good price for it. And I think it was about $3 million. And they came to me and said, okay, what are we going to have to tax we're going to have to pay on this? And so we started looking, okay, what's your cost basis? The first question I asked, and well, we don't know. Mom and Dad gave this property to us during our lifetime. So we went to talk to Mom and Dad. Says, what's your cost basis of the property? Says, well, we don't know because Granddad gave it to us during lifetime. So we go to Granddad and said, what's your basis in the property? He says, well, I got this property in a poker game back in this was several years ago, but back in 1912. I won it in a poker game in 1912. So first of all, this is before the imposition of the federal income tax. And so the basis would in effect be zero. But at that point, this property was a vacant field. It was a pasture. There was no timber on it whatsoever. And so even if he would have bought it and paid something for it back then, the timber, there was no timber on it. So they had no cost basis in the property, in the property or the land or the timber. And so they had to cry all the way to the bank because they made $3 million, but they didn't have any cost basis in the property. So we have these land and timber accounts. So the total cost of the property, our total cost basis, is allocated between the timber and land accounts, and including this pre-merchantable account. And so these accounts must include all of the taxpayer's timber that's contained in one block. So the IRS uses this term block. Sometimes they call it a single identifiable property. But the idea of the block is it's all the timber in a unit. And the IRS gives you broad flexibility in terms of how you define this. So your unit, your block, can be one parcel. It can be a tax lot. It can be all the properties in one county. It could be all the properties that you own everywhere. It can also be broken down into plantations or particular areas within a parcel. The issue with a block is that you have to identify it, and then all of your accounting has to be done at the block level. So you have to keep track at the block level of all your investments and all your harvesting. So you keep track of your cost basis and your harvest and all the other activities that you do within that block. So most people, they try to keep this simple, and most small woodland owners have one block. They have all their timber in one block, even if they have multiple parcels. Other people do not. They'll keep track of their cost basis and each property that they have. And it doesn't matter. The issue is that once you decide how you're going to do it for that particular property, you don't change it. And so and you can change later if you want to, so let's say you decide you're going to put all your timber in one block that you own everywhere, and then you buy another parcel and you decide not to include that timber in the block. That's okay. But once you make that decision, then you're stuck with it going forward. This block is important because we'll get to depletion. We have to look, and the block is also, we use this for casualty losses. So we're looking at, when we measure your casualty losses, they're looking at what is your block, how are you accounting for your timber? And so then we look at the decrease in value. So we have to determine it, right? Remember, casualty losses, the difference is the reduction in value of your timber, and it's the lesser of that reduction or your cost basis. And so we're looking at it at a block level. So reduction of the value of the timber in the block compared to your basis of the block. And so so that block definition is important, And it's something, again, many of us haven't thought of in this way. And so this is one of the definitions that you need when you're starting to, if you're starting just to gather your records together, to be talking about what is the block. If you purchase standing timber, so you purchase a cutting contract, that has to be carried in a separate account. So you don't mix your basis with your cutting contracts in with your timber that you own. And the timber account that you have, this block, doesn't include the value of the land or any improvements. And so it just has the timber in it because we're going to take that block, the cost basis in that block, and that is what we're going to use to determine our depletion unit. So let's talk about depletion. So cost depletion is how we compute depletion for timber. So it's a particular concept. And so we look at the cost that we have in our timber. We basically divide it. So we determine a depletion unit for the year, and we multiply that depletion unit by the number, by how many, whatever the unit is. So if our depletion unit is based in 1,000 board feet, then we take our depletion unit times the number of board feet. If our depletion unit is in tons, then we do it in tons or units or whatever number. For the most part, we're using board feet when we're determining our depletion unit. We can have within a block, you can have like all your Douglas fir and all of your alder and your maple and other things. You can have different categories of timber inside the block, and you can maintain separate cost numbers for each of those different types of timber. And some people do that and some don't. So how do we determine the depletion unit? We compute the depletion unit every year where we do a harvest. And that computation is we take the basis of the timber that we have remaining, plus the cost of any timber that we acquired during the year, plus any additions to capital to that timber. So if we, spent some money on the timber that we haven't been able to depreciate or to deduct. So in any cost that we have for the timber, we take that cost and we divide that by the number of units, so whether it's board feet or tons or whatever, however we're measuring. We take our cost divided by the total amount of timber that's standing in the block at the beginning of the year. So we take it's in the units on hand at the beginning of the year, plus anything that we acquired during the year, plus any adjustments that we need for growth or corrections. And so we can, let's say we start and we know we've got, when we bought it, there's 100,000 board feet of timber on the property, and we know it's growing 5% a year. So the next year, we just say it's 105,000, and then that 105,000 grows 5%. And so we can continue making estimates. But at some point, probably we go then and we do a cruise. When we do a cruise, then we make an adjustment to whatever number we're carrying on the books to whatever the cruise is. And so we can adjust it based on our assumptions. We can adjust it based on again, the amount of timber that we think is growing there. And then, but whenever we do a cruise or we actually get a hard number for how much timber is there, then we're supposed to correct the number to whatever the number actually is. So we can adjust it based on our assumptions as we go forward. But whenever we do a cruise, then we come up with the hard number. So we divide our cost basis over all the timber that's standing. And that gives us our depletion unit. And what that really means is that we don't get back all of the cost basis unless we cut all of the timber. So, if we have 100,000 board feet, or we have 1,000,000 board feet, and we sell 200,000 board feet, we're basically taking out 20% of our timber. So we're going to get 20% of our cost basis back. And so how this computation works looks like this. So I've got a couple of examples in the materials. So we'll start off here with this example number one, where when we bought this property, the value of the land was $150,000. The value of, let's say there's 1 million board feet of timber on it. Value of that timber was $450,000. So the total value of the property was $600,000. But we only paid $500,000 for it. So when we're looking at making this allocation, we look at our purchase price, but we also look at what is the fair value of these various components. And maybe we paid more than the fair value, maybe we paid less, but we have to look at both. And so this valuation exercise is again, done by crews, done by appraisal. We figure out what the land is worth, what the timber is worth, what any improvements were worth. We figure out what the percentage of those. So the land value is 25% of the total, timber value 75% of that total. Then we take what we actually paid for the property, and then we use those same percentages. So we paid $500,000 for it. So 25% of that we allocate to the land. So we give $125,000 to the land, and 75% allocated to the timber. It's $375,000. So in the year that we bought it, this is 1 million board feet on this property. Our depletion unit would be $375,000. That's what's allocated to the timber, divided by the 1 million board feet. So we'd have $375 per 1,000 board feet. Thing we know about timber is that it grows. So we go 5 years from now and we haven't done a harvest, that $375,000 number is going to stay the same until we do a harvest and we have depletion. But the board feet number is going to grow. And so our depletion unit will go down every year, just because the denominator of the fraction gets bigger. The 1 million board feet is going to grow to 1,000,001, 1,000,002, 1,000,005, and the 375 number stays the same. When we do a harvest, then we take out whatever we take for depletion, and we reduce that 375 by our harvest number. I've got another example where we can look at this. So this is a little bit more complex example, but let's say here we purchased this property for $200,000 back in 1990. And on the date of purchase in 1990, so we paid $200,000 for it, but we look at all the various components of value. We had 20 acres of timberland that was worth $10,000 back then. 100,000 board feet of timber was worth $30,000. There was a pole barn on the property. We allocated $20,000 to that. There was a residence, which included the lot, which is the land, and the house. So the land was worth $40,000 under the house, the ability to build on it. And then the house itself was worth $150,000. So we add up all those things, we come up to $250,000 of value that we acquired for $200,000. Then we allocate that $200,000 according to the various, basically the relative fair values of each item. So the land, the 10,000 divided by 250,000 is 4% of the total. So 4% of 200,000 is $8,000. So we're going to allocate 8,000 of our 200,000 to the land, 24,000 to the timber, 16 to the pole barn, 32 to the resident, so lot, $120,000 to the residents. If you didn't do this when you bought this back in 1990, you can still go back and do it now, but you do it based on the values in 1990. And if you had actually done anything, so like say maybe you set up the pole barn to depreciate it, and you allocated 20,000 or 16 or 18, whatever number you allocated to the pole barn, you're stuck with that number if you didn't do the rest of it. And so you can't go back and change something you did before, but if you never made an allocation, you can go back and do that now. And many of us haven't. We didn't do this when we acquired the property. And so it's possible to go back in time and do that, have somebody appraise the timber and then basically grow the stand back or degrow it back to 1990 and determine how much timber was there then and what the value of that timber would have been. So back in 1990, it was 100,000 board feet. Today, 2020, so 30 years later, that timber has gone up 5 times. It's now we have 500,000 board feet of timber on the property. We haven't done any harvest. So I think one of the questions that came up before the class started was, how do we know what there's 500,000 board feet of timber on there? Well, there's 2 ways to do it. And one is just you make an estimate of the growth, but really probably what you'd want to do if it's been 30 years is you probably, in fact, if you haven't established your cost basis anyway, you're going to have somebody that's doing some sort of appraisal or cruise now, and they're going to let you know what that number is. There is no requirement to cruise the timber, but you have to have a reasonable number. So it has to be something, if you don't have a third party telling you what the number is, then it's going to be, the IRS is going to be, the burden of proof is on you, the taxpayer, to show the value. So what you can't do is use the depletion unit based on the 100,000 board feet of timber that was back in 1990. It has to be the amount of board timber that's standing in the year of harvest. So in the year of harvest, we have 500,000 board feet. And we cut 200,000 board feet. So our depletion unit, we haven't done any harvest. We go back to the original cost that we allocated of our 200,000, $24,000. We divide that by the 500,000 board feet that's standing today. So our depletion unit is $48 per 1,000 board feet. So for every 1,000 board feet we take out of the woods, we get our cost basis is $48. And so we take that $48 times the 200,000 board feet that we removed. And so our depletion deduction is $9,600. So we sold that 200,000 board feet, whatever we got for that timber, and however we're going to report it. So we have the 200,000 board feet of timber, minus our logging and hauling cost, minus $9,600. And then we also, going forward then, the $24,000 of basis is now going to be reduced by $9,600. So we're going to have $14,400 of basis going forward, because we started with 24 and we've now used up $9,600 of basis. So that $14,400 of basis is going to be our new number carrying forward. The cool thing, so this is seems like a complicated computation. The Form T has a depletion schedule on it, and it goes through this entire computation and also gives you, we start with the number at the beginning. We have the ability to add board feet, to put in our, to make the adjustments. You calculate the depletion unit, and then you have the number that carries forward for next year or for future years. And so that Form T, the depletion schedule on Form T, is a great way to keep track of your cost basis in your timber. If you don't have any cost basis in your timber, because when you bought the property, there was no timber standing on it, then you don't have to worry about this. But the thing that we can't do, we harvested 200,000 board feet. We can't take all of our cost basis because we had 100,000 board feet when we started. We've now removed 200, so we can take the cost basis. That's not how it works. We have to divide our cost basis over all the timber that is standing in the year of harvest before the harvest. Okay. So that's cost basis and depletion. I've got some, there's I think a pretty good description of this in the materials. And so I'd encourage you to review that and go over it and go over it with your tax professionals so that they make sure that they've got your basis information correctly computed. One of the things that's, so let's say you buy a new piece of timber. So let's say you have this piece in 1990 that you owned, that you have this $24,000 basis, and now you've purchased a new piece of property in 2020, and it's got a lot of basis in the timber, and you're going to harvest both off of the old property and off the new property. So the question is, what's the best way to do this? And so you just have to decide, do you want to mix? You can put them both in the same block. And if you do that, put them both in the same block, then the $24,000 of basis you would have in the old timber would be added to whatever the basis you have in the new timber, and that would all be one number. And then you would have to figure out your board feet that's in the total block to compute your depletion. If you keep track of it on parcel by parcel basis, then you just would keep track of this parcel. You've got this number, you buy another parcel, you keep track of it, of that one. And there's different strategies. So some people like to, by mixing the old properties and the new properties together, it reduces the amount of, it'll increase the amount of income that you're going to recognize when you harvest on the new property, but it reduces the amount of tax you'll pay on the old property because you'll have more basis overall in the block. So you just have to kind of look when you put it together, what is your harvest strategy, and does it make sense? And how much work do you want to do keeping track of your basis and your activity on these different parcels? If all you want to do is keep track of one thing, then you want to have it all in one block. If you don't mind keeping track of the different blocks, then go ahead and do that. Reforestation. Now we're on page 6. So we talked about reforestation, I think in the first session. So, and what we said is that reforestation costs are capital costs. So reforestation costs, by definition, are added to your pre-merchantable timber account. So we call it maybe a plantation account. That pre-merchantable timber account, while it may be inside the block, is held separate from the block. So this pre-merchantable account, whatever costs are there, are not part of your depletion basis. They're not part of your cost basis for depletion. They are held separately until that timber becomes merchantable. And when that timber in that reforestation block becomes merchantable, then those costs then are freed up into the block as a whole. Or you can continue to hold them in a separate block for depletion. So you can make a decision there. So your reforestation costs, again, are capital costs. They're held until you have your, sometimes you see your first commercial entry in the stand, but it's when that timber first becomes merchantable. Then the costs are then moved out when they become merchantable. Now, the laws on how much of this we can deduct have changed over the years, and they probably will continue to change going forward. So, but the law right now, we have section 194A and 194B. So 194A allows us today to amortize 100% of those costs. So if we choose, we can choose to deduct 100% of the cost of reforestation, but it's over a 7-year period. It actually takes 8 tax years because in the first year, we can only deduct half a year. So it's 84 months and the period is deemed to start on July 1. So no matter when we did our reforestation, we start our amortization 84 months beginning in July 1 of the year that you did the reforestation. So that's an election we can make, Code Section 194A, and any taxpayer can use the 194A. Doesn't matter. So if you're a personal use, you're an investor, you're a business person, you're treated as business use, everybody can use 194. And we're going to talk about trusts too. Even trusts can use 194A. Partnerships, S corporations, regular corporations, everybody can use 194A. In addition to 194A, we have Code Section 194B. 194B gives certain taxpayers, basically all taxpayers except for estates and trusts, the ability to deduct up to $10,000 a year for each qualified timber property that they have. Any cost over and above that $10,000, then you can also choose under 194 to amortize. These are 2 separate elections. These elections have to be made on the timely filed tax return. If you fail to make the elections, the IRS will take those costs and just put them into a pre-merchantable timber account. They'll deny the deduction, and that timber will stay, the cost will stay there in that pre-merchantable account until that timber becomes merchantable, and then it'll get added to your depletion basis. So this is a big deal. If you don't do this or forget to do it, it can make a big difference on your tax return. And so 194A can be used by anybody. 194B can be used by everybody except for estates and trusts. So how do we do this? So the 194A and or B elections have to be made on timely filing return. There is no carry forward or carried back of these expenses. So you have these expenses in this year, and you either, these costs either get added to your your pre-merch timber account, plantation account, or you make a 194A or 194B election to deduct, to amortize and or deduct these costs. So that all happens in the year you do the reforestation. So the question is, what is a reforestation expense? And it's a fairly broad definition in the code. So it's basically all the costs to establish a stand of timber. And so it's all the costs to establish a stand of timber. And so it includes this, it's basically all the costs once the loggers move out of the woods until the trees are free to grow, which can be a 3 to 5 to 7 year period, right? All those costs from the moment the loggers leave the woods until the trees are free to grow are reforestation costs. That's the site prep, the clearing, the piling and the burning of the brush, the scarification of the ground, purchasing of the seedlings, the planting costs, and any brush and animal control that you have to do to establish the stand. It also includes the depreciation on the equipment. So if you use your own equipment to do these costs, it also includes the operating costs and the depreciation on the equipment that is used for this. So let's say you have a cat and you use the cat 30% of the year to, push to clean ditches and to maintain your roads, and the other 70% of the year you're using it for scarification and cleaning and site prep. Then 70% of the cost of operating that cat, well, fuel, diesel, repairs, and the depreciation, all that expenses are part of the reforestation cost. So it's a big number, including the cost of the planting hose and all the equipment that you use to do the reforestation. So all of those are reforestation costs. So that's a bad deal. It's a broad net, and it's not just in the year of planting, but it's stand establishment. Now, good news. The Christmas tree growers have won for us some very important cases in this area. And so they say stand establishment costs are capitalized, but we also have something called a stand management cost. The stand management cost can be expensed if you're a business, or we can capitalize them as a development cost rather than reforestation cost if they're personal use, or if you're personal use or investor. So in Oregon, we have a legal definition of stand establishment. Here on the west side, it's 200 trees per acre, free to grow within 5 years. So basically all the costs that you have to spend to meet the stand establishment requirement here in Oregon are considered reforestation costs. But any costs that you spend over and above that to promote the vigor and growth of the stand are considered stand management expenses. So what most of us are we're spraying, keep the grass down around this for moisture control. We're doing bud capping, we're doing other things, not to meet the stand establishment requirement, but because instead of 200 trees per acre free to grow in 5 years, what we want is 400 or 450 trees per acre free to grow within 2 or 3 years, 3 years maybe. And so we're trying to promote the vigor and growth of the stand so that we exceed the Forest Practices Act requirements. All those costs that we spend to exceed the requirement are stand management costs. The flip side of that is also true. Let's say we're planning on a south slope, and you've got to have, you're paying somebody to carry backpack and to carry water up to your trees, and you're putting all that, so you have heroic efforts to keep those trees alive. If you're spending that money because if you didn't spend it, those trees would die and the stand would fail, then that's a reforestation cost. So in addition to keeping track of all the costs that you're doing, you also keep track of why you spent the money, because again, the burden of proof is on you to prove that why this is not a reforestation cost. So if you want to deduct some of these costs, you need to basically document in your files that if you didn't spend it, you would still meet the reforestation requirement. So for example, most of us are planting 400 trees per acre or something like that. And if we walked away from our stand, we'd probably in 5 years on most sites, you'd still have 200 trees left. I mean, you'd have 50% losses in the stand. And so that planting of those trees is a reforestation cost. But if you could walk away from that stand at that point and you'd still have enough survival to meet the reforestation requirement, then probably any of the other expenses you spend on terms of bud capping and spraying and fertilizing and micronutrients and all those other things that we do, those are stand management expenses. And so again, it's just something that needs to be documented in your files. Post-establishment timber fertilization expenses. So many times in 10, 15 years, we're actually putting fertilization on a young stand to basically give them a boost. And those costs we used to have to capitalize that. The IRS has now said that those expenses are deductible in the year that we spend them. So we have post-establishment timber fertilization expenses. Again, if you didn't have to spend it to promote, to make the stand, to meet the Forest Practices Act benchmark for stand establishment, then it is a ordinary and necessary business expense. We say it's $10,000 per qualified timber property. What is a qualified timber property? It's a property that's inside the United States, held for commercial production of timber, consists of at least 1 acre planted with seedlings, and does not include Christmas trees. So you can't take the $10,000 on a Christmas tree plantation. Basically, that qualified timber property, you maintain separate accounts for each one, and you include all the reforestation treatments and the dates when you applied them, because you have to list all the things that you did. The seedlings, the clearing, you put all those costs down. You're actually required to disclose those things on the tax return and the dates when you did it. So those qualified timber properties, so say you had 4 different places that you did reforestation on. Each one of those, if they're separate in, they're not contiguous. If you've got separate areas that you did reforestation in, each one of those can be considered a separate qualified timber property as long as you maintain your records. So I spent these dollars on this part and I spent these dollars on this part. So again, to the level of detail that you want to maintain your records, you can have multiple qualified timber properties. But if you just have like a 40-acre stand and you clear cut and you replanted it, that's going to be 1 qualified timber property. How can we deduct reforestation? So if you're personal use or an investor, it's an other expense on the Form 1040. So it's not subject to those limitations. It actually is an expense you can deduct in the current year. If you're a business owner, you can deduct that. The amortization for the 194A goes in the Form 4562. That's a depreciation schedule. And the 194B goes just on the business schedule, the expensing part. We have to attach a statement to the return for each qualified timber property showing the description of the cost and the dates you incurred. So that statement has to be attached. That is the election. So we attach a statement under 194A or B that these are the costs that we have and which election we're making. Part 4 of Form T also has that same information. So we can meet our the statement can be the Part 4 of the Form T. We attach that to the return, or we can just attach a statement that's just typed out, which lists those expenses. If you sell the property within 10 years of reforesting it, those amortization costs get recaptured as ordinary income. So if you have a gain on the sale, to the extent that you took an amortization deduction or the expense deduction, then you basically, that part of the gain is treated as ordinary income, and then the rest of it is treated as capital gain. All right, roads. This was a very contentious issue with the IRS. It was settled back in 1993. And basically, they came down to two things. First of all, we have temporary roads. Those are skid roads, just used in the harvest. Temporary road, you push the road in, you drag the logs out on it, and then after the harvest is done, you basically water bar the road, you tear it up, maybe you go through and you scarify the ground, you loosen up to get rid of any compaction, then you plant across it. Those roads, which were just put in for that harvest, is included in our harvest cost. However, you put in a permanent road, a road, maybe you build it for the first time, or you put it in a road and you're going to leave it after the harvest is done, then that's a permanent road, even if it's just a dirt road. And so roads, those permanent roads, we have this, like, they have layers. And so the first layer is the ground part. And so we survey the road, we clear the right of way, we grub it out, maybe we have to blast some rock out of the way, then we grade the road bed and we put in the ditches. All of those are land costs. They're not land improvements. They just are added to our basis of land. They are not deductible. They add to our basis in the land itself. Once we have the road bed down, then all the surfacing, so the base rock, the top rock, culverts, trestles, bridges, gates, all those things that we put in on the road, those have a 15-year maker's class life. So, and we'll talk about what we can do with a 15-year class life property in the first, but anyway, they're depreciable assets and we can depreciate them. Once you have that road in, then repairing it after harvest and just doing ongoing maintenance, fixing potholes, things like that, those are deductible as long as we can meet the repair regulation requirements, which we talked about last time. So once we gravel the road, we put the surface rock down. The first time we gravel the road, put the surface rock down, that's a capital cost. We can actually use 179. There's other things we can do to get that cost back. After we've done it the first time, then we just fixing the road, maintaining the road. Those are operating expenses that we just deduct in the year that it's done. So depreciation, which is our last topic. So when we purchase a capital asset, and capital asset is, tangible properties, anything other than land. So tangible property, so the buildings, improvements on the land, machinery, vehicles, furniture, fixtures, equipment, all those tangible assets are capital assets, and we depreciate them. We also have some intangible property, patents, copyrights, and software. Software is an intangible asset, but we depreciate those as well. So in order to depreciate it, we have to own it, right? So if we lease the property, then we don't depreciate it, we deduct the lease expense. But if it's a lease to purchase agreement, so basically it's just a form of financing that's called a lease, then we're treated as being the owner. And there's a bunch of rules there, which we're not going to get into. But generally, if you own the property, or if you've got a lease purchase on the property, then you're going to be depreciating. You're not going to be deducting the lease payments. You're going to be depreciating it, and you're deducting an interest expense on we're going to treat the lease like a loan, and you're going to have your interest deduction. In order to claim depreciation, you have to be an investor or a business use. A personal use taxpayer cannot claim depreciation. If part of the asset is used personally, you can only depreciate the business use part. This is you see this most of the time with automobiles. So we own a vehicle and we use it 20% of the time personally and 80% of the time for business. And we spent, $50,000 on the vehicle. We can only depreciate 80% of it. So we take 50,000 times 80% is 40,000. So we can depreciate 40,000, 80% of the vehicle. And the other 10,000, the 20% that is that we own personally, is not depreciable. Depreciation begins the date the asset is placed in service. So how do we compute this? So depreciation, just like depletion, it reduces our basis in the assets. And if you're a business if you have a business use, your business classification, the basis is going to be reduced by the depreciation that's allowed or allowable. So whether or not you take the depreciation deduction, you're going to have the basis reduced by the amount of depreciation that you should have taken. And so this is a really complicated topic. Many people will, they're using professional tax preparers just for the depreciation part. There's a lot of software out there that can help you compute depreciation if you're trying to do your own returns. But basically, if you're a business use taxpayer, you're required to compute depreciation and reduce your basis. You take the deduction, and your basis in the asset is reduced. Any property that's been purchased after 1986 is under what we call MACRS, the Modified Accelerated Cost Recovery System. There's an IRS publication, 1946. It's got really detailed information. It's a pretty good publication. If you're trying to do this on your own, or even if you want to know more about it, I would tell you to Google IRS publication 946 and download it, or just read it online. MACRS is, we got two systems, the general depreciation system, the alternative depreciation system. Basically, the general depreciation system is, if you're using that, we have the potential to have alternative minimum tax. So we have the alternative depreciation system is basically what we use for alternative minimum tax. And so there are differences. The ADS system depreciates things more slowly than the GDS system does. Under MACRS, we have categories of assets that are assigned to class lives. And so everything is based on the class life of the asset. And based on that class life, we go to different tables in the publication 946 to determine the amount of depreciation deduction we get this year for the assets that are in that class life. So I've got this is in your materials. I've got kind of here a summary of the things that you'd mostly run into. So a 3-year property, these class lives are based on the number of years basically it takes to do the depreciation. 3-year property is depreciated over a 3-year period, 5-year property over a 5-year period, and so on. So the 3-year property are over-the-road tractors. So that's if you have a semi, the tractor part of the semi is 3-year property. You have race horses over 2 years old. So very few people have those. 5-year property is vehicles, trucks, office machinery, computers, dairy cattle, appliances. If we've got a residential rental, all the equipment and all the stuff in the residential rental, and new farm equipment is 5-year property. 7-year property is the one most of us have. That's office furniture, used farm equipment, farm fencing, and property with no class life, which would include basically almost everything. So our chainsaws and all the stuff that we use in the stuff, or if you've got actual machinery that you use for logging, most of that is 7-year property. 10-year property, single purpose ag structures. Those are like greenhouses and foaling sheds, things like that, that's a specific description of those things. And if we have trees or vines that produce nuts and fruits, so like your vineyards and the fruit orchards and the nut orchards, filberts and things like that. 15-year property is where our land improvements come in. So our fences, our sidewalks, our bridges, the rock in our roads, those things are all 15-year life. 20-year property is farm buildings. So if you're a farmer, Schedule F, the farm buildings go there. 25-year property is municipal sewer. 27.5-year property is our residential rentals. So if you have a rental that you're renting out to somebody, 80% of the income from the building comes from using it as a dwelling. Then you use 27.5-year MACRS, and then all other buildings get a 39-year life. So that's MACRS. You take the life times the table, and it comes up with a deduction. Now, in addition to MACRS, we have 2 other types of depreciation. The first one's called Section 179. 179 is basically an election to expense property that you acquired during the year. And you can elect to deduct all or part of the qualifying property. And there's some limits, but the limits are really big. So qualifying property is basically all tangible property, tangible personal property. So it's everything that you buy that isn't attached to a building, if you can move it, it's basically tangible personal property. The single purpose ag structures, computer software, non-residential real property improvements, which include like putting our roofs, HVAC systems, alarm systems, security systems, fire equipment. So those things are eligible for 179. And improvements to the interior of a non-residential building. So other than enlarging the building or putting an elevator, escalator, or modifying the internal structural framework. So basically all the kind of tenant improvements that we would normally do in a building are something we can now do section 179 on. So how much can we deduct? We have a dollar limitation and a business income limitation. The dollar limitation is $1,040,000, and it goes up every year with inflation. So if you buy more than just under $2.6 million of equipment, you have to reduce that $1 million limit, but it's a big limit. So most of us, we're not running up against a dollar limit. If you buy a heavy SUV, that's a vehicle more than 6,000 pounds, the maximum 179 is $25,900. But that does not apply to pickups over 6,000 GVW as long as it has a 6-foot bed or longer. So I guess Hummers had a 5.5-foot bed. They wanted to make sure the Hummers were not included in the pickup description. And so those are heavy SUVs, and they limit the ability for people to write off a Hummer, spend $100,000 and get a section 179 deduction. But you buy an $80,000 pickup, you can write it all off in the current year. So that is the dollar limit. We also have a business income limit, which basically says that we can only take 179 up to the amount of taxable income that we have from a trade or business, from all of our trades and businesses. And that includes basically the income from the business. It also includes our wages from another business. So, if you're a doctor or a dentist or something or a professional and you're earning, $100 million a year in a W-2, and you've got your tree farm out here that maybe has lost money, you get to combine those two things together to determine your section 179 limit. So the net effect of 179 is 179 can't get you to a loss, but it can get you to zero. If you have a pass-through entity, a partnership or an S-corp, they're subject to the same limits. However, trusts and estates are not eligible for the 179 deduction. So if you have a trust or estate that is a partner in a partnership or an S-corp, then they can't take the 179, the partnership, the S-corp can't take the 179 deduction for the percentage ownership that the trust or estate. So if a trust, the estate is 20% of the ownership of the entity is held by that, then they can only take the 179 on 80% of the assets. And then the other 20% they can take a regular depreciation deduction for. The 179 passes out. It's a separately stated item in the Form K1. So the 179 out of a partnership or S-corp actually comes through to the owners. So we have that income limit and the dollar limit inside the entity. And then it comes out and we have that same dollar limit and business income limit that's applied to the individual. So if you have 5 businesses, they can all have a 179 deduction, and then it passes the individual, and the individual has their own limit as well. And so you can't basically game the system by busting your business up into 5 businesses to boost your 179 deduction. The limit is both at the entity level and the personal level. Final thing we'll talk about is what we call bonus depreciation. This is something that's been in and out of the code, and right now it's in the code until the end of 2022. So we've got it in this last year, 2020. We'll have it in 2021. We'll have it again in 2022, assuming the government doesn't change it again. But bonus depreciation is taken after you take the 179 and before you compute maker's depreciation. And so section 179 can get you to 0. The bonus depreciation can take you below 0. we can create a loss with the bonus. It's 100%. So it's basically just like Section 179. It's 100% of the assets that you acquire. So we can write it off. And so whatever you don't write off under 179 can be written off under the bonus depreciation. And in fact, is written off under the bonus depreciation because it's the default treatment. So this is Code Section 168K. So we have the bonus depreciation occurs, and it basically wipes out. I mean, you basically get back the cost of this equipment, and then it's only equipment that doesn't qualify, then that goes to makers. You can choose to elect out of the bonus depreciation and let it go into the maker system. But the default is that you take the bonus depreciation first. So what gets the bonus depreciation? It's tangible property with a maker's class life of 20 years or less. So this is all your roads, your bridges, culverts, and then all the equipment, everything that you buy in the year. So anything with a maker's class life of 20 years or less, even farm buildings, are subject to bonus depreciation, and 100% of it gets written off in the current year unless you opt out. Computer software and trees and vines that were grafted and planted between this time period. So this bonus depreciation is the default. You can elect out of it, giving the code sections there and in the book and your materials. There's also the instructions for Form 4562, which is the depreciation schedule, tells you what you need to do to elect out. Why would you want to elect out? Maybe you don't want to have a big loss this year. Maybe you want to depreciate it over time because you know you're going to have more income in a future year, and maybe you can't deduct the loss this year. Maybe you don't want to worry about carrying the loss forward. And so there's lots of reasons why people opt out of the bonus depreciation, but you have to opt out on the timely file of return, and you opt out for each class life separately. So you opt out for the 5-year property, the 7-year property, the 15-year property, the 20-year property. You'd make a separate opt-out election for each one of those class lives. And with that, I know your head, this is really dense stuff. That's why I've got the information here, and I've included where to go for more information, because these are topics that are challenging for people, especially if you're trying to do your own returns. But I think it's also important that you understand how this stuff works, again, so you can have an informed, intelligent conversation with your tax professionals. And with that, Tammy, I'll go ahead and shut this down. And if you've had questions, if you haven't put them in the Q&A yet, go ahead and do that. And I'm sure, Tammy, you've already have some for us.
I do, and so we'll kind of start from the top. If you wanted, could you identify plots on a particular tax lot, understanding that accounting would have to be done per plot, especially if doing a rotating harvest?
Yes, you can. So you can keep that block as small or as big as you want. And the IRS basically says, look, we don't care, but whatever you do, you need to do it consistently. So if you want to measure those, do it by plot. And I have got clients who do that. In fact, I have commercial clients who do that, who, buy this big place and they've basically identified, here's timber that we want to take out early, and here's timber that we want to take out later. And so they took the timber they want to early and they put that in one block, and the timber they want to take out later, they put that in another block. And so, yes, you can. The challenge is you have to measure all your costs and your harvests by block. And so you have to do all your counting, and it's a lot of work, especially if those blocks are in one parcel. So just realize you're setting yourself up to do quite a bit of work if you want to do that. But the IRS will allow you to do it, but you have to be consistent. And once that timber is gone, you still have to maintain the block. And so you're stuck once you make the election, or once you actually do the accounting the first time, then you're required to be consistent from that point forward for that block.
Great. So a couple more basis type of questions in the front end here. You made reference to the timber basis at the beginning of the year. So if you're unsure of when you will harvest, is it a good practice to check the timber prices at the beginning of each year for reference material?
No, you don't have to do that. So it's actually it's the only time you use the value of the timber is when you do a harvest and you're using 6 and 631A to determine your gain. That's the only time you have to worry about value. So you would do that after you've done the harvest, and then you would go back and then figure out what the value of that timber was on the first day of the year. It doesn't have anything to do with your cost basis. Your cost basis is based on your original acquisition price carried forward, plus any adjustments. If you make investments that you were not able to deduct, then that adds to your basis. And then any depletion that you take reduces the basis. And so that's the number that you track is your cost basis going forward. And then the other number that you track is the growth in the timber, not the value, but the growth in the volume. And really, you only have to update that in the year that you do a harvest. Some people, it's easier. Maybe you have your internal inventory system, or if you're keeping track of your timber and how it grows, you can update that. But you really only care in a year when you do the harvest, because you take your original basis divided by the timber that's standing in the year of harvest, and that gets your depletion unit.
However, I will say, if you know that you're going to wind up doing 631A, it's probably not a bad idea to kind of keep track of that beginning year price in that particular situation. So,
although many times, my experience, especially in a larger harvest, is that spot pricing is probably not going to get you the answer you want. That's why I go to people like, there are appraisers out there that do a lot of financial modeling, especially in a large harvest, where you're going to get a bigger number than you are just with the spot price from your local mill. Because we're not just looking at what you could sell it for, looking at what would Weyerhaeuser do, or what would IP do, or one of the big companies, and what are their costs. So it's not what you could sell it for on the spot market, it's what they could do maybe in all the markets that they have, and what they're paying on a commercial level, not what we're paying as small woodland owners. And so that number is higher because it's a valuation number on an open market versus what maybe you can do personally.
all right, can you speak to the basis for mature timber in riparian areas which have been designated as no touch in the management plan?
So the timber basis is for the block, and the block includes the riparian area. So even though you can never cut those trees, your basis, is allocated. Now it depends. Many people I know, when they buy the property, they allocate zero basis to those trees in the original allocation. And if so, then that's fine. You basically said, my block consists of all the timber outside the riparian area. And therefore, you're not going to pick up the value of those trees in your, which will allocate more of your purchase price to the trees that are not in the riparian area. And I see many people do that. So you have to, in terms of the cost basis, it depends on how you originally did it. If you originally included those trees in your cost basis, which is okay, then you can, though, for purposes of determining your depletion unit, you can exclude that volume from your depletion unit calculation. So you can just take the timber that's harvestable, because that's really the number. It's the timber that's harvestable is the volume of timber that you use for the denominator in that fraction.
Great. I'm going to read you this one. It came in through email. So this is regarding the example 2 on page 5. And it talks about where you have grown the timber. And I think the wording in your example, I'll read from the example, that in 2020, the volume of timber has grown to 500. And so this is what this question is relating to. Are there right ways and wrong ways to determine that the volume of timber had grown to 500,000 board feet? And then is an appraisal required if the harvest volume is above a certain amount?
Yeah. So any reasonable method does not require an appraisal, does not require a cruise. It's any reasonable method. However, the burden of proof is on you. And if the IRS disagrees with your reasonable number, and you don't have any third-party evidence to show that that's a real number, then you're going to lose, and the IRS is going to impose their own number. And so that's why I say it's anytime the numbers are large, if you're doing a big event, maybe this is a generational event, you're going to harvest and you're going to have $500,000 of income or something. It's a big event. Engage some professionals so that you've got third-party evidence of the numbers that you're using. If you're harvesting 5 truckloads of timber, don't worry about it. But if you're taking out 200 truckloads of timber, you can afford to get a cruiser to come in and help you, and maybe even an appraiser to help you determine the 631A and all that. There's enough dollars on the table to pay for it, and it's going to, again, the IRS then has a so if you've got a third party number, then the IRS has got to prove that your appraiser was not being reasonable, and that's a much higher burden of proof than if you just you took your number and you just and say, hey, this is what I kind of thought it was that yesterday. I took an azimuth on the moon and added 2 decimal places, and feels good to me.
I'm going to put the forester hat on for a minute and say that, if you need that depletion number this year, it's because you're doing a sale. If you're doing a sale as a forester, I'd like you to have some kind of idea of what volume is out there in the first place. Yeah. So before you put it up for sale, you should always have some kind of idea what's out there, whether that's a preliminary cruise, some even accrued cruise, so that you have an idea what you're putting up for sale. That's how you get your best dollars, is understanding what you're selling. And then that's going to feed into that depletion number. So even if it's a thinning or a clear cut, either way, you should have some idea what's out there.
I think in addition to that, so you don't get robbed, right? I have so many people that came up to me and said, somebody was driving by and they came and knocked on my door. And they said, hey, I'll buy that timber for you. And I'll give you $150,000. And they said, oh, it was more than I thought it was worth. But I mean, they had no idea.
Exactly. And that's why I say, there's 2 reasons why to have some kind of idea, right? So you get the right amount in your sales transaction, but also so that you can properly calculate that depletion unit. Now, if it's a clear cut, you need it for the sale and you don't need it for the depletion because you're going to wipe wipe that out for that block anyway. But if it's a thinning, especially, it's really important to know what you're selling and maybe even think about having it marked to make sure that you have the right trees going out the door. So think about it as an investment in the stand that you have out there, but also in the tax treatment being properly done.
Anytime I have somebody come and do a cruise, I ask them to give us some management prescriptions. Let's make it work for a couple of reasons, right? Let's not just do for the harvest, but also let's maybe get some management prescriptions for the timber that we're not going to cut, so that we can, maybe update our management plan, or maybe, at least get some ideas of things that you could be doing with the property or should be doing over the next 5-10 years.
Right. All right. So this is moving a little bit into, I think this is crossing into reforestation. So I'm going to ask you to clarify some things based on what you hear in this question. I think it's going to show you some misunderstanding. If the timber property acquired with a recent reforestation is already done, is the treatment of the allocated cost basis to a plantation account treated the same as in your reforestation discussion? So I think this is the allocation and the reforestation getting crossed here. So if you can clear that up.
Yeah, if you buy a parcel that has just been reforested, you would allocate part of your purchase price to the pre-merchantable timber, but you cannot take 194A or 194B because you didn't spend the money. So so you would allocate it, but you would not be able to make the 194A or B elections on that. So it's only if you did the reforestation that you can make those elections. So you are required, if you buy the property with pre-merchantable timber, it doesn't have to be just a young plantation, it can be 10 or 15-year-old timber as well. You're required to take that cost, whatever the value of that timber is, and put that in a pre-merchantable account until that timber becomes merchantable. But you're not able to use the reforestation, you're not able to expense that. Once that timber becomes merchantable, it will go into your depletion base.
Yeah, and that's really important. I've had somebody contact me recently that had not allocated any basis to that young plant. It was probably a 2-year-old plantation when they bought it, and didn't see any value in it. And so as you're going through that basis allocation, really think about what you're paying for. Somebody's already invested those dollars. You paid for it.
Yeah.
And so it's really important to make sure you don't exclude those acres.
And it's a substantial number, right? I mean, it could be, brand new plantations, $400 or $500 an acre.
Right. And now it's 2 years in. So
Yeah,
now it's good value.
Yeah. And, you get into 5-10 years, it could be a couple $1,000s an acre. I mean, that stuff it's valuable. And so, yeah, you should, if you acquire property or, when you inherited it or, whenever it came across, if there were young plantations on it, that you should make sure you get those valued and allocate part of your purchase price to that.
Yeah, and let's be really clear, the consequences of not doing that are going to hit you when you hit that sale on that. And so while it might not seem consequential right now, it will be. It will still be dollars that will reduce your sales price in the future. And so it's absolutely worth having it.
Yeah.
All right, so this moves into 179 deductions.
Mhm.
Said you mentioned trusts can't take the deduction through a pass-through entity. Does that restriction apply to a revocable trust that is a member of an LLC pass-through entity?
Yes. So it does not apply to a revocable trust. A revocable trust is what we call a disregarded entity. So the IRS doesn't recognize a revocable trust as a taxpayer. That's why the revocable trust does not file a tax return, right? If you have a revocable trust, all that income is taxed to you as the grantor, as the owner. So any revocable trust or what we call grantor trust can take the 179 deduction, can take the reforestation deduction, because as far as the IRS is concerned, they don't exist. What we're talking about here is an irrevocable trust, a trust that's set up maybe after somebody died or set up for somebody before they died, but it's filing its own tax return. Or it's or an estate. Somebody dies and for the period of time the estate's open, it's taxed under the trust rules as well. And so they also are not eligible for 179 or for the 194B election. Now, the difference between 179 and the reforestation election is that with the 179, basically the pass-through entity has to make an adjustment. They can't take 179 for the trust beneficiaries, so trust owners. The 194B election, they can do that. And so they're going to, if they pass out the 194B election, then the trust or estate basically takes that amount and then they can make an election to amortize that amount over, instead of taking the deduction, they have to add it back to their income. And they can either choose to amortize it over the 7 years, the 84 months under 194A, or they can add it to their basis in the timber. But that one can pass through. They just can't take advantage of the deduction.
So I think you might have answered this one, so I'm going to read it. How does a revocable trust deal with the 194B provisions or section 179 deductions?
Yeah, so revocable trust, it is disregarded. So we don't care. It's just treated, you are the taxpayer. The trust is not the taxpayer. So that's the distinction.
Okay.
So revocable trust, this does not affect. But say after you die, and you set up a trust, maybe a credit shelter trust or family trust for your kids, and it's going to own the timber, or you set up a marital trust for your spouse, and it's going to own the timber, those trusts can't take the 179 deduction or the 194B election. But the trust that you have while you're alive that you're using instead of as a will substitute, you put all your assets in there so you don't have probate when you die. We don't. Those trusts are not. They're disregarded for income tax purposes, which is why you don't have to file a trust return while you're alive.
So this is going to, I think, go one more step on this trust thing.
Okay.
Did we make a mistake by putting our property in the name of our revocable family trust when we purchased it? Our revocable family trust when we purchased it?
No. In fact, you did a good thing because you're going to stay out of probate and all that. So no, that's not a problem. At death, it's just, it made something, the status is going to change when you pass away. But no, during lifetime, the revocable trust strategy is a great estate planning strategy. Stay tuned this fall. I think we're going to be talking about estate taxes. So we'll come back we've got big changes, looks like, coming to us in the estate tax realm. And so we're going to be chatting about that later this fall.
All right, and this is the last question I have. Is can a corporation deduct road costs under Section 179?
Yes, corporations. Now, again, roads have layers. My kids are big Shrek fans, so onions have layers. Roads have layers, and so that road grading, surveying, grubbing, all the ditching, all those costs are land costs. Those are not deductible at all. They get added to your basis in the land. But the bridges, the culverts, the surfacing, which is the base rock and the surface rock, all of those are depreciable assets, and they are right now they're bonus depreciation assets, and they are 179. They are not 179 assets because it's not qualified 179 property. So you can't take a 179 deduction, but you can take the bonus depreciation deduction.
Great. That's all we have.
Look forward to seeing you next week. We'll be talking about form of business. So we'll talk about partnerships and S corps and LLCs and all those things and how they're taxed and why maybe what are the advantages of one form or another. And then we have some wrap up issues, things like cost share and other things that we haven't had the time to talk about, carbon payments, things like that. So those will all be next time.
Great. Thanks so much, Clint and Tammy. This has been a great session today, and I just want to refer you all to the link that's in the chat to our website where all the past videos, slides, and handouts are posted. Thanks again for participating in OSWA's taxation series. OSWA members pay dues that support events like this. So if you are not yet an OSWA member, now would be a great time to show your support and join OSWA so we can continue to provide valuable landowner education like this that helps you manage your woodlands. You can join by going to our website, www.oswa.org, and clicking on join/renew. With that, thanks so much for joining us today, and we'll see you in 2 weeks.